I'm Tom Staub, founder of the Real Estate Investing Academy. Today, we're going to be talking about how to get started in investing in stocks. So let's get to it. Hey there, everyone. Welcome back to another podcast. So today, we're going to be talking about how to begin to invest in stocks. And this is a huge topic, right? And there's not any way that I could cover this in 10, 15, 20 minutes. And it would take years to really deep dive into what it takes to properly manage a portfolio. I tell you my background. I started, researching stocks when I was probably 17, 18 years old. I'm now 35, and so it's been a long journey. And I recall going through college, I used to spend nights, instead of partying, I would break into the literature and arts building where they had this wonderful classroom, and I would open up my personal, my finance and corporate finance and stock books, and I would just read and write the formulas on the board and try to understand them in depth. And throughout college, I was the president of the investment club for 3 years. Beyond that, I traded most of my time in college to be able to pay for college. And then, I worked at Morgan Stanley with 18 phenomenal traders and CFAs. I went through corporate finance and my MBA, and I've been trading all along and reading dozens and dozens of books. And today, what I'm going to tell you is how I really just boil it down to the things that I wish someone had just told me back then. So that's simple, right? And there's a number of ways to look at stocks, and depending who you talk to, it's that process or the way to analyze a stock is going to change, right? Everyone has their own techniques that are experienced, but at the end of the day, there's really two classes of thought, okay? On the one side, there is something called fundamental analysis. People who believe that the analysis of a stock really comes down to the company's profit and loss statement, balance sheet, and cash flow statement. And cash flow is actually the most important one because it drives a lot of how you value a company down the road. And there's a fairly complex process by which you basically need to build out cash flow statements and balance sheets and P&Ls of a company, and then forecast, a 2, 3, 4 year timeline. And then when you hear something in the news, you change certain numbers in those financial documents, and that converts into a price per share. Super involved. Now, here's the thing. When you talk to most people about picking stocks, they don't know this because they haven't had the training and the schooling to do this. But I'm telling you, this is a process by which many of the traders on Wall Street use, and it's called the discounted cash flow analysis. You're basically trying to understand what the value is of the future cash flows of that business, and then bring it back to a price per share, okay? And earnings per share, price per share, right? Now, there are faster ways to do this, right? And you don't have to do it that meticulously, but I'll warn you, if you're really going to start trading, you got to at least understand what it all means, okay? So there's a fundamental. And then there's something called the technical, right? And the technical traders use charts, they use patterns and momentum, mathematics to try to predict the future of a stock by using the history of a stock. Now, I'll tell you that there's a lot of debate as to whether or not this is even effective. I think there's some general rules of thumb, some general methods that you can use to at least evaluate technical analysis. It's also, again, pretty complex. The whole world of stock investing is very complex, almost designed by nature and designed intentionally so. But I'll tell you that technical and fundamental, okay? Both, I think, can be used simultaneously. When I used to trade actively, I would use both. Hey, this stock looks like it's undervalued. Where is it trading on momentum? Okay, well, there seems to be a huge influx of buying right now. Why is that? Or selling, why is that, right? So that's generally the two schools of thought. Now, there's a lot of other nuances that goes into picking a stock, right? And some of the key things that I look at, and this is very common, but you'll want to understand valuation formulas, right? So if you think about it more just in a personal life sense, if you go to a shoe store And let's say you buy a pair of Nikes every 2 years, right? And it's the same pair of white Nikes that you buy, and you know that for 2 years, they'll last you, and then you have to get a new pair every 2 years. Ordinarily, they cost $100. You would say that you're paying $50 per year, right, of use. And so if they went down to $80, then you could say, well, now I'm paying $40 per 1 year of use. Well, the stocks can be analyzed in a similar manner. It's something called the PE ratio, price to earnings ratio. And what it really means is how many dollars are you willing to pay for $1 of earnings? Now, this is a quick gut check formula. For example, the S&P 500 over the course of time tends to trade around a 13 to 16 PE ratio, meaning that on average of the top 500 companies on the stock exchange, people tend to pay between $13 to $16 per $1 of earnings. So very simply, if that goes up beyond that, you have to be asking the question is, well, why is that? Are people betting on maybe hyper growth, faster growth in the future, or the denominator is earnings, right? So price divided by earnings. So, if the earnings drops, then the PE ratio goes up. If all things being constant. So my point is, again, it's a good gut check to say, hey, typically this stock trades at 20 at a 20 PE. It's now trading at a 15 PE. Is this a good time to buy? Again, that's more of a fundamental sort of thought process. And within all of this, there's a number of these valuation formulas. And if you really want to understand how to trade stocks, you have to generally understand, at least in my opinion, the technical side of the business. And then also you really need to understand the fundamentals of how to value a stock. And this is just scratching the surface. There is a lot more that goes into picking a stock. Really, you need to understand, economics and how something like the recent stimulus packages may flow into the value of the dollar and how that might impact the price of a stock. And so simply understanding how to use the two schools of thought is just scratching the surface. You really have to become an economist and understand not just how to measure a stock, but all the other variables that go into that. Okay, so it's a long equation, and what I'll tell you is that what I have learned in my life is that you can buy on dips. And this is a big one, right? So big companies, think of like a Boeing, right? They have government contracts of billions of dollars that the government is going to hold them to build out machinery, jets, you name it. They're going to be building these things. Same with Raytheon, Lockheed Martin. And to think that these companies will go bankrupt is just silly. It's not going to happen. The government needs them. And so when you see a substantial dip, just like we saw in early 2020, when Boeing dropped below $100 a share, I knew that like this is hilarious. Look at the PE ratio. Look at how low this share has gone. There's no way this is going to stay here. They're too big to fail. And so if you look for companies that take dips, and a dip is 10, 15, 20%, that would be the same as when your Nikes go down to $80. You pick those up because ordinarily they're 100. And that frame of thought is really called contrarian. So you're doing essentially the opposite of what the herd is doing. The herd is selling, you pick up with what they're selling. And again, there's a lot of different techniques, and we'll go through them in other videos. But at the end of the day, really it's fundamental understanding, and then it's the technical analysis understanding. And then beyond that, understanding the broad economy and how that impacts your stocks as well. Okay. Now, what I have learned is that it's a lot of work. A lot of work to be listening to earnings calls, to be researching stocks. And so what I have done instead is adopted the portfolio by Ray Dalio, who is arguably the world's most successful hedge fund manager, president of Bridgewater Associates, with $160 billion under management. I use his strategy. It's called the all-weather strategy, or all-weather portfolio strategy. And occasionally I will adapt those variables accordingly, but in general, I use that to manage my portfolio. So with that said, look for more of these videos in the upcoming future. Thanks.